Let's do an example to show how site retirement costs are dealt with under IFRS. As always, read the question first. Pink Inc. developed a mine in northern Ontario and began mining gold immediately on January 1st, 2019. The company's management estimates that the mine will be productive for 10 years. Environmental regulations require the company restore the mine site to its original state at the end of the mine's useful life. Management estimates that it will cost $2 million to restore the site. The company presently borrows funds at 8%. The company uses IFRS and the straight line method of depreciation. Record all the necessary entries for year 1 and 2 of the 10-year production life of the mine. First, we need to calculate the present value of the future restoration costs at the end of the mine's useful life. So let me just put down some particulars. It's $2 million. The periods are 10 years. The interest rate is 8%. Now, you can use present value tables or your calculator in order to calculate the present value of the $2 million today. I'm going to use present value tables using P of 10 and I of 8. So that means $2 million. And if I look on the present value chart, I see that the factor is 0.46319. That is equal to 926,380. That is the present value of the future site restoration obligation. An entry can now be made. The asset retirement costs can either be added directly into the cost of the asset or recorded separately. I'm going to record it separately because, to tell you the truth, I don't know what part of the mine I would put this in, so I prefer to record it separately. I'm going to move the page down. So this is, of course, on January 1st. So I now have an asset account called Site Restoration, 926,380, and I also have a related liability, 926,380. Both the debit and the credit accounts are names that I use, I made up, but other names that are descriptive can also be used. So keep that in mind. Sometimes when students look in textbook, they try to memorize the name of the accounts, which is a good idea. You know, accounts receivable, accounts payable, these are standards. But these accounts, I've made them up. If your textbook shows something a little bit different, don't get too freaked out. It's just a name. The accountant in the company will decide the name that is descriptive for them. In addition, the debit may be directly to the asset account itself, such as equipment or land. So keep that in mind too, but I'm going to keep it separate. That's my choice, professional judgment. So the asset account for the asset retirement costs is depreciated just like any long-lived asset, using the same depreciation method and estimated useful life as the related asset. In this case, that would be straight line and 10 years. At the same time, the obligation must, at the end of the 10 years, be equal to $2 million. That's required in order to restore the site. Therefore, every year, the company has to recognize the interest on this obligation. This will increase the obligation liability until after 10 years, it's equal to $2 million. So I can do a depreciation schedule as well as an obligation schedule, and that's what I'm going to do right now. I'm only going to do the first, let's say, 3 years, because I don't want to put 10 years down. So I'm going to do my usual titles, which is the date, the depreciation expense, the accumulated depreciation, and then of course the carrying value. I'm going to start my schedule for January 1st, 2019. None of these things have happened as yet, but I want the carrying value in there, which is 926,380, which is the value of the asset with regards to the retirement costs. So now fast forward to December 31st, 2019. What is the amount of the depreciation? Well, we can calculate that, right? I'm going to calculate it over on the side in a different color. So I have 926,380 divided by 10 years. There's never going to be a residual value ever with regards to this, right? And this is equal to 92,638. So that is the amount of depreciation that has to be taken every single year. So that means the depreciation expense was 92,638. Accumulated depreciation 92,638. And then, of course, the carrying value is this amount, subtract the accumulated depreciation, and that would be 833,742. And don't forget, at this point, I would do the entry on December 31st, 2019. I would do my standard entry to recognize the depreciation. So I've got December 31st, 2020. This is 92,638. Accumulated depreciation, I'm going to add this in to calculate it. That is 185,276. I'm going to subtract the original value, 926,380, minus the accumulated depreciation. That is equal to 741,104. And this, of course, is the 926,380 minus the 185,276. All right, now fast forward to December, and I would do the entry, of course. Now I'm at December 31st, 2021. I'm going to have 92,638. I'm going to add it in here. This is going to be now 277,914. If I now calculate the carrying value, which would be 926,380 minus the 277,914, which is equal to 648,466. Now, I could keep going, right? I could do 2022, 23, 24, da, 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 da. So now the last year I'm going to take is December 31st, 2028. Because when you look at it, we did 2019, it's 10 years, right? 28 is the 10th year at the end. So I'm going to take 92,638. I would have to have calculated all the other accumulated depreciations, which I did. They are all equal to 926,380. And of course, that means that this value at that time is going to be zero because I'm going to fully have depreciated the site restoration costs. So I've done the depreciation schedule. I also have to show the obligation schedule. Remember, the liability is only sitting right now in January 1st of 2019. The obligation is sitting at 926,380. But by the end of the useful life, it has to be sitting at $2 million. The obligation schedule has a date. It has the interest expense. And then it has the present value. At January 1st, 2019, there's no interest expense. We've just got the present value of 926,380. But then when we get to December 31st, 2019, we have to calculate the interest expense. How do we calculate the interest expense? The interest expense is always calculated as the current present value times the discount rate. And keep in mind that I'm going to round this to the nearest dollar. I'm not going to keep pennies in it. So 926,380 times the 8% discount rate is equal to 74,110. I'm going to add that into my present value because my present value has to keep increasing until it hits $2 million. 1,490,000. I would have to do an entry at December 31st, 2019 to recognize the interest expense and the increase in the liability account. And we're going to do that in a minute. So now we're at December 31st, 2020. We've got 80039. And again, this was $1,490,000 times 8%. So I'm taking the current present value and multiplying it times the discount rate. I'm going to add that in, bring it over here. This is 1,080,529. Notice that the interest expense is going up as the present value increases, and that's going to continue to happen. So December 31st, 2021, we would have 86,442. This would be added in. This would be equal to 1,166,971. Now, we could keep going, but we know in the very last year, at December 31st, 2028, we're going to have a present value equal to $2 million. The interest will have to be calculated, but we know that at the end of the period, and I think the interest is going to, don't quote me on this, but I think the interest is going to be 148,164. But regardless, it's whatever interest it takes to get to the $2 million, because at the end of the 10 years, we have to be sitting at $2 million, because that's the amount of the site restoration costs. So what are the entries that would have to be made every year? Because we haven't done the entries. Well, what are the entries? What would they look like? We already know what entry we would have made at January 1st, 2019, because we did it. But at December 31st, 2019, what are the two entries that would have to be made? Well, first, I have to recognize the depreciation, and I have to recognize the accumulated depreciation. And for 2019, that would be 92,638. This is an adjusting entry. It's a deferred expense adjusting entry. We should know this from our introductory financial accounting. In addition, there has to be an entry for the interest, because the present value has to increase according to the schedule that we did. So that's going to be a debit to interest expense, 74,110, and a credit to our account name that I chose, provision, 74,110. Every year we're going to make these two entries at the end of the year. The only thing that will change is the value. Well, the depreciation is going to stay exactly the same, 92,638, but the value of the interest expense and the provision site restoration will continue to increase as the obligation schedule shows. So I'm going to do one more year just so it's clear. Debit depreciation expense, site restoration, credit accumulated depreciation, site restoration. And then, of course, I'm going to recognize that the obligation is increasing. Debit the interest expense, this time for the amount that's on the schedule. It's 80,039. Credit the provision. Is there anything else with regards to site restoration that we need to understand? Yes, one more thing. What if site restoration costs change? Well, asset retirement costs must be adjusted annually for any changes. If anything changes, the amount of the obligation, the timing of the obligation, or the discount rate, the changes have to be reflected with regards to the asset retirement costs. Note that these changes are a change in estimate and therefore are dealt with prospectively. That's it for dismantling and restoration costs.